On today's call, we have Mr. Jonathan Hunt, Syngene's Chief Executive Officer, and members of Syngene's management team to discuss the financial and business performance for the Q2 FY19. After our prepared remarks, we welcome your questions. Before we begin, I'd like to caution you that comments made during this conference call today, October 25, 2018, will contain certain forward-looking statements and must be viewed in relation to the risk pertaining to our business. The safe harbor clause indicated in our investor presentation also applies to this conference call. The replay of the call will be available for the next few days immediately after this call, and the transcript will be made available in a week's time on the company's website. With that, I will turn the call over to Syngene's CEO, Mr. Jonathan Hunt. Over to you, sir.
Thanks, Karthik. And good afternoon, ladies and gentlemen. Thank you for joining us on the analyst call today to cover Syngene's second quarter and half-year performance for FY19. I'm going to start my comments by giving you an overview of the quarterly financials and then follow it up with operational updates. I'm then going to invite Mr. Chinappa, our CFO, to give you a little more detail on our financials for the quarter in his address. So let's start with 2Q performance. I'm happy to report that Syngene registered a 24% growth in revenue during the second quarter. That's with our reported revenue growing from 352 crores in the same quarter last year to 437 crore this quarter. Overall, that growth was well balanced across the business, with both our small molecule discovery services, that's discovery chemistry and discovery biology, as well as our dedicated centers showing good traction. As you may recall, over the last few quarters, we've announced the renewals of our ongoing collaborations with BMS and Baxter, and we're now starting to see that reflected in the growth within the business. Turning briefly to profitability, EBITDA for the quarter was up 12% to 145 crore, and that compares with 130 crore in this quarter last year. Looking at the reported PAT line for the quarter, that was up marginally, up by 1%, taking it to 78 crore compared to 77 crore in the last year. And this is in line with our plan, and I think it reflects pretty much the investments, the continued investments we're making in enhancing our safety, quality, and systems in our sales and marketing activities as well. So let me turn quickly now just for some of the highlights for the first half. Revenue was up 31% to 862 crore, while EBITDA was up 12% and PAT was up by 4% at the half year. I'm not going to go into more details around the financials. I'll leave Chinny to cover that in his comments. So just looking now at the operational updates for the quarter, sure you're all familiar, Syngene's business is broadly categorized into three verticals: discovery services, development services, and then the dedicated R&D centers. And in our dedicated R&D center vertical, we see that really as a differentiated business model that allows us to provide integrated drug discovery and development services to our clients through the setting up of a dedicated research facility. Teams of Syngene scientists then work side by side with our clients' R&D teams around the world within these dedicated facilities, and we do that to deliver drug discovery and development projects. So currently Syngene's got 4 of those dedicated centers, one each with BMS, Baxter, Amgen, and Herbalife. And as I mentioned over the last few quarters, been particularly good for this vertical with the renewal and expansion of our ongoing collaborations with BMS and Baxter. Happy to share then that we're making good progress on those expansions. We inaugurated and commissioned a new dedicated facility for BMS during the quarter, so that's now up and operational. Also on the operational front, we're making good progress on our investments focused on improving and strengthening our safety and quality systems. And we really see these investments as a source of differentiation in the market and something that adds real value to our clients. Now, Syngene's growth over recent years has really led us to invest a lot in people. And as we've seen our business grow, we've seen our employee base increase proportionately. So during this quarter, we made some further additions to our leadership team with 2, I think, significant appointments. Alok Malhotra joined us as Chief Quality Officer. He's going to be responsible for Syngene's quality function and will spearhead our initiatives to further strengthen Syngene's track record in regulatory compliance. Alok comes with 25 years or more experience across multiple industries, including a real depth of experience in pharmaceuticals and pharmaceutical manufacturing. Harry Jose joined us as Head of Marketing. He'll be responsible for our strategic marketing and brand building initiatives. He joins us from Emphasis, and I think his experience is really going to help improve our overall brand identity. So in closing, from me, we're making good progress, I think, on our strategic plans. Our ongoing investments to improve operational efficiencies are already starting to show some results, and I think it's really going to position us well for the second half of the year and to continue to provide great value to our clients. So with that, let me turn over to Chinny to share a little bit more on our Q2 financials.
And good afternoon, everyone. Over the next 5 minutes or so, I shall share more details around Syngene's Q2 revenues, the profitability, and update you on the ongoing CapEx program. During the quarter, we delivered 24% growth at 437 crores as compared to 352 crores in the same period last year. As Jonathan mentioned, the growth for the quarter was well balanced across all verticals with very good traction in discovery services and dedicated R&D centers. We also had a 7% benefit on account of the currency move. Gross margins for the quarter, and by gross margins I mean total revenues, less material cost, less employee cost, and less power cost, is 46%. So the gross margins for the quarter is 46%. This is in line with our full year FY18 reported gross margins. Our EBITDA for the second quarter is at 145 crores. This reflects a 12% increase as compared to 130 crores in the same period last year. The lower growth in EBITDA is reflective of investments towards commercial activities as well as strengthening our safety and compliance initiatives. Our profit after tax at 78 crores is a notch higher than the net profits reported during the same period last year, and as you may recollect, reflects the twin effects of increase in depreciation and increase in income tax. Our EBITDA margins at 33% and PAT margins at 18% respectively is as per our expectations indicated earlier in the year. I would also like to call out here that the reported revenues for the quarter include interest income of 18 crores. Associated with this are finance charges of 8 crores and income tax of 6 crores. If we exclude the impact of interest income, the revenue growth for the quarter is 25%, and adjusted EBITDA and PAT margins for Q2 FY19 are 30% and 18% respectively. A quick comment on the effective tax rate. As we had commented in the past, the effective tax rate for H1 FY19 has increased and is now at 20% compared to 19% in H1 FY18. This is due to the unwinding of the SEZ tax holiday benefits in some parts of our business. I will now turn to Forex and the impact of the currency movement. As you are aware, our revenues are predominantly invoiced in US dollars, while our reporting currency is in INR. During the quarter, we had a Forex loss of 5 crores compared to a gain of 12 crores in the same period last year. This reflects the difference between the hedge rates versus the prevailing spot rates. As we are fully hedged for the second half of FY19 at around rupees 70 per dollar, we do not expect any gains from the recent rupee depreciation to impact profits over the next 2 quarters. I will now quickly touch base on some of the balance sheet items. We have spent approximately 300 crores towards the ongoing CapEx programs. As a result, we have reported a net debt position of rupees 1 crore as of September 30, 2018, compared to a net cash position of rupees 320 crores as of March 18. We have committed an additional 10 million in the first half of this year against a total CapEx commitment of 200 million. With this, our total committed investment stands at 118 million as of September 30th of 2018. This includes $78 million for expansion of facilities in Bangalore and $40 million towards the upcoming commercial API manufacturing facility at Bangalore, which is scheduled to be operational by the end of FY20. As we mentioned in the last quarter, we have reinstated the first phase of the upgraded H2 unit, and we expect the second phase to be operational by the end of this fiscal. With regards to the insurance claim, we have so far received 81 crores, and we expect to receive the balance proceeds over the next 12 months. Finally, to summarize, it's been a good quarter and revenues are in line with expectations. We expect to maintain the momentum for the rest of the year. With this, I will now conclude my financial overview and open the call for questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question at this time, please press star 1 on your phone. We have the first question from the line of Nitin Gosar from Invesco Mutual Fund. Please go ahead.
Hi, Chini. You mentioned about the hedging.
We have to speak up. Unfortunately, we can't hear you.
Yeah, is it better now?
That's a bit better. Thank you.
Yeah. There was one comment on the hedging part, currency hedging, and if I get it right, then till FY19 and you are adequately hedged and you may not see the INR depreciation benefit, which currently is happening. In that case, would FY20, when the contract gets renewed or repriced, do you see some kind of readjustment and then finally the INR depreciation will start flowing down to your bottom line? How should we look at it?
Okay, so just to rephrase that, Chini, I think the question overall on our hedging policy, if you maybe go back to the beginning, why do we hedge, how do we hedge, what's our general dimensions around the policy, and then maybe comment on the specifics of where we are given the current sort of market movements.
Nitin, as we had commented in the past, hedging policy tends to look at a full hedge over the first 12 months and a partial hedge over the next 12 months. And at the same time, all our long-term fixed price contracts we look to hedge completely. This is to kind of not have forex fluctuation on the books impacting the profitability of the contracts or the BUs in particular. So in this sense, that's helped us over the years to average out the impact of the rupee structure movement. If you recall, in FY17, the rupee averaged at about 65, at which point we realized close to 67 to the dollar and recorded about 23 crores of hedging gain. In FY18, the rupee actually appreciated towards 64 levels. However, we realized 68 is to the dollar, and that's reflected in the 73 crore hedging gain for FY18. This year, we're hedged in the 69 to 70 levels, and as of the first half, we have recorded a 5 crore forex gain, but that's 10 crores gain in the first quarter and a 5 crore loss in the second quarter.
Okay.
Going into the next year, similar to our previous, in line with the hedging policy, we are hedged at a rate which is higher than this year and closer to the current prevailing spot rate.
Okay. Sorry, just harping on it further. So the 69.70 where we hedged ourselves and current rate being 73. So after 12 months, which is probably maybe around April or maybe around June next year, that's when you'll start seeing the actual real rate or the freshly hedged rate getting reflected into your numbers.
Yes.
Okay. And so my second question was pertaining to the dollar-denominated growth. So from here on, the growth which we are witnessing in second quarter, should we consider that growth to be the momentum to go by, keeping in mind the scale-up which we are seeing in the dedicated service segment?
So I'll just again take you back to the guidance that given at the start of this fiscal. We had said that we are looking at FY19 growth to be much higher than the revenue growth that we reported for FY18, which was 17%. And we said this growth will be despite the lowering of tax incentives and interest income in FY19. So the core sales growth as we see it will be higher than what we had projected, than what we delivered last year.
Fair point, sir. Thank you.
Thank you. Next question is from the line of Charul Geran from Dalal and Bocho. Please go ahead.
Yeah, hi. My question pertains to the increase in material costs. There is a 38% increase. Whether you expect it to continue at this rate, or is it a temporary phenomenon?
Yeah. So again, as I mentioned in my commentary, look at the gross margins as a net of employee cost, material cost, and power cost. So if you look at that, we're at 46%. The gross margins is 46%. And that's in line with Q1, in line with last year's full year average. And when you look at Q2 of last year, there was some thing that we had this additional export incentives that played out, and that gave us a higher revenue and a higher margins in last year. But if you really look at a full year average, 46% is the current run rate.
Okay.
But sometimes when the projects involve a higher, the development work that we do tends to have a higher material cost. The discovery services, we do have a higher employee cost. But the blended combined cost is about 54% of that.
Okay. Okay. And my second question pertains to the investments in building capabilities, safety systems. I think FY18 it has tapered off so far, but further investments in building capabilities, will it lead to a further pressure on profits?
So if you step back, I think the sort of narrative we've given throughout the year is that one of the reasons that Syngene does well, particularly with what I think is a marquee international clientele, is that we stand out in the marketplace and we're positioned as a premium service provider. And that's not just premium in the sense of pricing, that's premium in the sense of the quality of the infrastructure that we have, the training and capability levels of the staff, the quality of the science and the innovation that we deliver to our clients, and also the systems and processes. And in a regulated industry like ours, with clientele that put a great deal of store on those issues, investments are ongoing, I think continual, and we're constantly needing to be pushing to make sure we maintain our position as being strongly differentiated on those attributes. So for me, it's not a one and done. I think it's a constant need to make sure that we operate at the very highest levels. But parenthetically, that's an investment in future growth. So the reason we're growing at 24% in the quarter is precisely because we win new mandates from marquee clients, and they do that because they have a trust in our systems and quality and our operations. So it's a virtuous circle that I hope we continue to invest in, because it's one of the things that's creating value. So that's a sort of contextual answer to your question. I think there's more to be done, and therefore I would expect, at least for a period in the future, that you'll see us to continue to invest. Now, of course, at some point, you expect to see the operating leverage come through as a benefit from that. But I'm not going to give a specific point estimate when in time you'll see that. But I think the direction of travel is clear. Hopefully that helps you with some context around the question rather than a specific modeling answer.
Right. Okay, but do you think it would pan out in a year or two?
Well, as I said, I don't think at this stage I'm going to call a particular quarter for you.
Okay, fine. Thanks. Hello.
Ladies and gentlemen, we are unable to hear the management. Request you to kindly stay on hold while we reconnect the management line. Thank you. Ladies and gentlemen, thank you for your patience. The management line is connected. Over to you, sir.
Hello?
Yes, we can hear you.
Good. So I'm waiting for the next question.
Sure. The next question is from the line of Surya Patra from Phillip Capital. Please go ahead.
Yeah, thanks for this opportunity. So on the growth front, this quarter we have seen stronger growth, sure, but and that is largely coming from the dedicated center vertical side. Also the development and manufacturing side. But can you just give some more clarity? See, we are seeing that, okay, we have seen some of the developments on the dedicated center vertical front, but on the manufacturing and development front and the discovery services front, if you can give some clarity about the growth visibility or what are the key drivers of the growth in the subsequent period, then that would be useful.
Okay, look, I'll see what we can do to help. As you know, we don't break out vertical by vertical segmental reporting, so you have to forgive me if I talk around the subject rather than sort of list off specifics. If you look at the quarter, the 24% growth, I think actually one of the key drivers of that actually was the performance within the discovery services vertical, and that's got two elements to it. It's got what we do in chemistry, so discovery chemistry, and what we do also in biology. Now, if you go back, and I can call out, say, for one example with a client, you know, we told you some time ago that we won a new mandate with GSK. A lot of that is in both chemistry, a little bit in biology. That's starting to gain some traction there. But in general, I wouldn't point to a particular client win. It's actually more broad-based than that. It's just a general uplift amongst a number of our client relationships where, you know, we're doing a little bit more work for them, whether it be fee-for-service or on an FTE basis. So broadly doing well. I think biology, and again, this is an 18-month, 2-year or so narrative that we've talked to you about. We have, I think, in our biology capability, a really differentiated team. I'm not sure if there's anybody else in the Asian region that really has the depth and breadth of experience or the scale that we have in discovery biology. And that then is a very attractive proposition for many of our clients around the world. A depth of talent and a great operating cost environment, which means that we can be both productive but also very cost conscious on their behalf. So that I think those are the things that say around the discovery services. We called out that we're seeing some good traction in the dedicated centres, but I wouldn't really break it apart beyond that. On the manufacturing side, you know, I think we all know where we are. We have ambitions and we have a good plan to forward integrate into manufacturing. But as of today, it's not a major driver necessarily of the organisation. There's a large amount of CapEx going into our API commercial manufacturing investments over in Bangalore. but we're sort of a year away from that even being built, never mind being operational. So actually manufacturing is not the majority driver of the business today, but it's a strategically important set of capabilities that we're building for the long term. The one area where we have put CapEx in the last couple of years that's now up and operational, that's manufacturing, is in the biologics piece. We have a reasonably sized biologics capability. It's a new entrant into that market, and it sits in that sweet spot between sort of clinical development scale manufacturing and small scale commercial. And that's come online in the last couple of quarters, and you can see that starting to contribute to the revenue growth. But there's a lot more to be done. We're still a relatively new entrant in that marketplace. But thank you for the question.
If I just ask something more on the biologic services front, what are the incremental trends that you are observing, Jonathan? Say like currently I believe it is only 10 to 15% of the biologic services are outsourced. So what is the current trend that you are witnessing and where you are progressing on the biologic front?
Yeah, I mean, actually, if you step back, it's not it doesn't need to be a massively complex analysis. If you look at, say, human life sciences, so pharmaceuticals and biotechnology, and you actually look at the industry's pipeline, it's sort of 50-50. If you look across any of the major pharma or biotech companies, half of their projects will be traditional sort of small molecule chemistry based, half of them will be biotechnology, often biologics, and within that often monoclonal antibodies. So the industry's moved to a strategy that is almost sort of platform technology neutral. It's just about the best tool for the job. And then unsurprisingly, almost as a lagging indicator, the CRO, CMO industry is matching that. And you can see, if you look at some of the giants in that sector, Lonza, Samsung, one or two others, are putting in an awful lot of capacity, and they're doing it in a strategic partnership model with many, many companies around the world. So I think that the market size is large, and there's a shortage of high-quality, available capacity. So if you can meet that, if you can meet people's quality requirements, if you can meet the flexibility they need to have immediate capacity available, I think there's some good opportunities, and that's really, for us to execute and make sure we do that well.
Okay. Thanks for that. Just a couple of questions relating to the financials. So you just in the opening remarks indicated about 18 crore of some one-off number that is there in the top line. Can you just please clarify that?
No, 18 crores of other income, which is the interest income.
Okay. That is one. And secondly, on the gross margin front, sequentially there is a meaningful improvement, obviously, because of the last quarter's one-off treatments what we had witnessed. But what is coming, what portion of this positive swing is coming from the rupee depreciation, and what is the core trend that you have really that has expanded the margins?
So on the revenue front, as I mentioned earlier, we had a 7%
swing on because of the
Yes. If you look down to the EBITDA margin, since we were hedged, let's say the 3 rupee move should have shown up as forex gains. Now, instead of having forex gains, we have a higher revenue and a forex loss in the expense line, giving us an EBITDA margin similar. Had the rupee moved or not, our EBITDA margins would have been quite similar.
Okay. But, sir, my understanding is, please correct me, see, with the increasing kind of asset utilization for the new capabilities what you have recently opened, I think with the increasing utilization, your margins would also improve because the unobserved cost, what it is when the issue, that will gradually come down?
Yes, that will play out in the subsequent quarters. As the revenues pick up, you'll start to see that benefit flow through. But of course, as Jonathan said, we continue to invest into the business to build stronger capabilities that can drive long-term growth and profitability.
Okay. And just last one question on the BMS part, sir. So now with the expanded and extended relationship, so what is the scope of team building capability that we are having? Say, for example, we are currently having around 500 odd FTEs dedicated for BMS. So with the expanded and extended relationship, what is the scope there one should really consider?
When we signed the expansion contract, we did give the numbers around the expansion. It was a 15% growth.
15% growth annually, sir?
No, 15% growth in the numbers, and then there are price adjustments, etc.
Okay. Fine. Thank you. Wish you all the best.
Thank you.
Thank you. Next question is from the line of Anand Padmanabhan from Renaissance. Please go ahead.
Thank you for taking my question. I just wanted some better clarity on your guidance, on your margin guidance. I understand that you have guided that the FY19 margins would be in line with the Q4 FY18 margins. Now, if I look at your H1 margins, which is around 30% if I adjust for the last quarter's one-off, this implies that H2 should see substantial uptick in your EBITDA margins. So could you give some light on what could be the key drivers of this margins?
Hi, Anand. This is something similar to what I just answered to Surya's question, saying that over time these revenues will grow on the same asset base that will give us a higher margin. So typically H2, in April of each year, our fixed cost goes up to reflect the wage inflation. Over the year, as the revenues build up, the margin expansion tends to happen as it covers up for that fixed cost increase. So
basically your personal cost and your SG&A cost would more or less maintain the same run rate that you are as of now, whereas your revenue will continue to increase.
Yes, it won't grow in proportion to sales, and that will give the benefit of the margin expansion in H2, which will then bring us closer to our guidance.
Okay, and in your SG&A in the last couple of quarters has seen steady uptick. So are there, what is the trend, or are there any specific items, or could you give some more colors on what's driving this uptick in your SG other expenses?
So Q2 has been slightly lower. The overall increase in the SG&A is reflective of what we discussed earlier, is the increased investment into the business as we're looking to build capabilities as well as strengthen our infrastructure around safety, quality, etc.
Okay, but this line item will continue to grow for the remaining quarters as well?
Yes, it is on an upward trajectory, but at which point the benefits will flow through. We don't want to give that point estimate on that.
Oh, okay.
But Chinny, just to sort of recap, in terms of the overall guidance on where we expect to be over the course of a year or multiple years on EBITDA and PAT, and then from there I'll leave it to the analysts to interpolate what's going to happen each quarter. But I think we've given a fairly good route map of where we're going over the long term. I mean, in general, at both the EBITDA and PAT line, for the sort of company we are, and for the industry we're in, we're an upper quartile margin business. And we think that reflects the fact that we offer differentiated, high-quality services to a global clientele. So if you could just sort of recap where we thought we would be indicatively on EBITDA and PAT, and then that gives the bookends for everybody else to be able to work out what they think the path during the quarters will be.
Thank you, sir. That answers my question.
Yeah.
Thank you. Next question is from the line of Mayank Hayanki from Axis Mutual Fund. Please go ahead.
Hi, can you detail us about the expansion plan in the sense that, what all has been incurred of the $200 million and what all is yet to come? And beyond that, have we put any figure of how much do we want to spend beyond the $200 million plan which we had, from FY16 to FY19?
Yeah, I mean, just to recap, Chile, as I recall, $200 million overall CapEx plan covering 2 or 3 years for the business. The first phase of that was investments here in our headquarters campus in Bangalore. Much of that is now been invested, completed, and is operational.
Sorry to interrupt. So I'm at page number 29 of the presentation, where you have the detail of the presentation, right? And they've written the CAPEX investment area. So I assume that these are the areas which were there in the $200 million plan. So if you could just highlight which of these have been completed and commercialized, and which of these are yet to come. The page 29 of the presentation.
So it's largely divided between these 3 groups, right? It's the
right.
Biologics, the formulations, and the R&D center.
Right.
All of them are operational, but that's in the first 100 million capex. All of them are operational, and as we scale up, there is an additional investment that we'll make to up to full capacity. So that's around these 3 centers. So all are operational, but all have some additional investment to go.
Okay. So most of these 3 areas, when you say, the research center, formulation center, API plant, and most of these are operational, but there'll be some expansion that keeps on happening in these plants.
That's right, yes. And the second bit is the Mangalore. The second 100 million is Mangalore, which is invested over the rest of this year and FY20 to be complete by the end of FY20.
Okay. Thank you. And operator, we're ready to move on to the next question.
Sure. The next question is from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Yeah, thanks for the opportunity. The question, just trying to understand the current capacity utilization that from the existing facility in Bangalore on an overall basis.
Okay, could you be more specific? Which particular the business were you thinking about? Discovery services, product development, formulations, manufacturing?
I mean, if you could help us with all 3, that would be great, or even a blended would work.
Okay. Well, it's going to be difficult to do. We don't actually have a single unifying utilization number. On the basis, if you think about the business, it would be difficult to calculate that. So the majority of what we do is human-based sort of work product. It's scientists delivering innovation for our clients. So it's often on an FSF or FTE basis. And in general, I find all of our scientists are 100% occupied. So if you think about it, the key utilization rate you're looking for in an FTE business is the productivity day-to-day of your research staff, and that's the majority operating model across Syngene. On the other 2 areas, where you're looking at things like formulation development and you're looking at chem development and biologics, we just don't publish a metric. But as you can see from the sort of productivity, profitability of those businesses, we're reasonably efficient.
Okay. I was just trying to understand, like in the last 6 quarters, we've added a lot of capacity. So would that have been gone full-blown and fully utilized, or there is enough or more capacity for the next couple of years within this expanded additions that we have done?
It would be unusual to bring online new manufacturing capacity and have it running at 100% occupancy quickly. So there's headroom for growth, but that's exactly what the business case is. It's to put that in. And again, it's sort of, it's counterintuitive, but the quicker we're looking to have to invest more capital, the healthier indicator is that we're getting our strategy right around matching services to demand. So I look forward to having to expand our manufacturing capacity still further. The general trends, particularly on the biologics, I think are reasonably healthy.
Understood. And lastly, on the cost front, there has been several questions and answers. I was just trying to understand, like with the senior hires of Chief Quality and Marketing, you think the large part of the cost is behind and now this is the, the base and we would see probably a high single digit or low double digit early teens kind of growth on that number? Would that be fair to assume?
Well, I don't think the appointment of two individuals is the driver of our cost base, given that we're up to 4,500 staff. So I wouldn't single those two out. I think actually the reason for mentioning them is they're more an indicator of the areas which we think we can gain value by investing further in. So strong quality systems, FDA compliance, global regulatory compliance, automating and informating those systems and really making sure we maintain what we do today, which is operating at the very best standards globally, and we keep that as a differentiator, I think is important. So I think you can expect us to continue to be willing to invest in those areas. On the commercial side, we've done a couple of things over the last couple of quarters. We set up a U.S. subsidiary, which is effectively a sales and marketing venture. We've hired seasoned sales professionals in those regions, so in the U.S. We're doing similar things in Europe, getting closer to our customers. So I think that third arm to that then is bringing in a capability in the organization around brand building, use of other channels like digital. Now, it's an investment. It's a small drag in the shorter term on the business, but it's not a transformational sort of level of cost investment for a business of our size. So we'll continue to do that.
I understood. Thanks for the detailed, discussion. Just to clarify, I was meaning that large part of our hiring is largely done is what I meant, not about the two individuals moving up the cost. Would that be fair to assume that large part across quality, across marketing and other functions is largely done? Ongoing normal growth continues, but a large part is done. Would that be fair to say over the last 6 quarters?
I think we'll continue to hire talented people to create value in those areas, but it's quite small numbers in comparison to our overall scale. If you built a large marketing team in a business like ours, what's it going to be? 5 people? I don't know, but it's very, very small in comparison to an organization that's got almost 4,500 staff. So I get the premise of the question. I just don't think that the hiring in those particular areas is a strategically important driver of our cost base. Okay. It may be a strategically important investment in our revenue growth, though.
Yeah, understood. Great. Thank you and all the best.
Thank you. Next question is from the line of Krishna Prasad from Franklin Templeton. Please go ahead.
Hi, thanks for taking my question. So, if I look at the second quarter, you had a 5 crore forex loss. Given where the rupee is today or maybe at the end of the second quarter, can you just talk about what will be the forex loss for, let's say, the second half of FY19?
Okay, so Chinny, it's very similar to the earlier question where you sort of reprised our hedging approach and policy. Do you just want to maybe summarize that again?
No, I don't want the policy. I just want to know what kind of, are we expecting similar level of losses or will the losses go up as we go into the second half of the year?
Yeah, and as Chinny sort of thinks about the answer to that, partly if you understand the policy, you could maybe predict that.
We have actually given an indication in our opening commentary that we hedged under 70, around rupees 70 to the dollar. So depending where the rupee trades, that will be the gain or loss. Our hedge rate is 70. If the rupee is at 73, there will be a 3 rupee loss.
You get it. We're fully hedged.
And what's the total outstanding hedge amount that you have, or the entire sales is hedged?
But what will matter is what's the hedge for the next 2 quarters.
Mm-hmm.
And that would be, roughly, is the net exposure, so it tends to be in about 50 million per quarter.
50 million a quarter. Okay, got it. Okay. And, if I look at the balance sheet and, I see that there is a net derivative liability of about 133 crores, which used to be a positive number until March, right? I mean, that's primarily because of currency movement, I guess. So this 133 crores of net derivative liability will get paid out over which period? I mean, is there a broad timeline that you can talk about?
Goes up to 2026.
Okay.
About 2 rupees per dollar.
Okay, up to 2026. And is there any, I mean, most of it happens at what point? Or, I mean, is there some broad sense of that?
Well, it varies.
Okay, all right.
Effective hedge, so it's linked to certain contracts, so that varies quarter to quarter.
Okay, and just very quickly, what is your CapEx number for FY19 and FY20? If you can just give the specific number, that will be useful.
I'll just get back to you because, but by and large, we'll look to complete the $200 million.
Yeah, but if you can just give the number, that's easier because this is a little bit more confusing to understand.
I'll just get back to you with the more exact because FY20 there'll be additional capex that will come on board. So I'll get back to you for certain in the next investor call. We'll update on what FY19 and FY20 numbers will look like.
Thanks.
Okay.
Yeah, so, operator, I think we've got time for one more question.
Sure, sir. It's from the line of Rohan Advan from Multi-Act. Please go ahead.
Yeah, thanks for the opportunity. So my first question is that in the last quarter, you'd called out a 40 crore amount that was in the revenue and had a pass-through of RM. So is there any similar amount in this quarter?
No, Rohan. That's why we did not call that out in the opening commentary. The revenues and costs do not have any one-off line items here in Q2. Okay.
So, and on the derivative liability that is on the balance sheet, does that pertain to our foreign borrowings?
Across it, like it's the effective hedge on our net forex flows, for cash flows, which is adjusted for revenues and borrowings.
Okay, because you said it is up to 2026, so I mean that would be for borrowings, right?
No, we have contracts, revenue contracts also that's run up till that day.
Sir, and just lastly, what was our average USD INR rate at which revenues were booked in this quarter?
Kind of average close to 70, that translated to that 7% currency gain that we got.
Okay, thanks for taking my questions. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Karthik for his closing comments.
Thank you everyone for joining today's call. Hope we have answered all your queries. If you have any questions, please feel free to get in touch with me. Have a good evening.